Types of ETFs. Various types of ETFs are available to investors that can be used for income generation, speculation and price increases, and to hedge or partly offset risk in an investor's portfolio. Here is a brief description of some of the ETFs available on the market today. Passive and active ETFs. ETFs are generally characterized as either passive or actively managed. Passive ETFs aim to replicate the performance of a broader index, either a diversified index such as the S&P 500 or a more specific targeted sector or trend. An example of the latter category is gold mining stocks. As of February 18, 2022, there are approximately 8 ETFs which focus on companies engaged in gold mining, excluding inverse, leveraged, and funds with low assets under management (IUM). Actively managed ETFs typically do not target an index of securities, but rather have portfolio managers making decisions about which securities to include in the portfolio. These funds have benefits over passive ETFs, but tend to be more expensive to investors. We explore actively managed ETFs below. Bond ETFs. Bond ETFs are used to provide regular income to investors. Their income distribution depends on the performance of underlying bonds. They might include government bonds, corporate bonds, and state and local bonds, called municipal bonds. Unlike their underlying instruments, bond ETFs do not have a maturity date. They generally trade at a premium or discount from the actual bond price. Stock ETFs. Stock equity. ETFs comprise a basket of stocks to track a single industry or sector. For example, a stock ETF might track automotive or foreign stocks. The aim is to provide diversified exposure to a single industry, one that includes high performers and new entrants with potential for growth. Unlike stock mutual funds, stock ETFs have lower fees and do not involve actual ownership of securities. Industry sector ETFs. Industry or sector ETFs are funds that focus on a specific sector or industry. For example, an energy sector ETF will include companies operating in that sector. The idea behind industry ETFs is to gain exposure to the upside of that industry by tracking the performance of companies operating in that sector. One example is the technology sector, which has witnessed an influx of funds in recent years. At the same time, the downside of volatile stock performance is also curtailed in an ETF because they do not involve direct ownership of securities. Industry ETFs are also used to rotate in and out of sectors during economic cycles. Commodity ETFs. As their name indicates, commodity ETFs invest in commodities, including crude oil or gold. Commodity ETFs provide several benefits. First, they diversify a portfolio, making it easier to hedge downturns. For example, commodity ETFs can provide a cushion during a slump in the stock market. Second, holding shares in a commodity ETF is cheaper than physical possession of the commodity. This is because the former does not involve insurance and storage costs. Currency ETFs. Currency ETFs are pooled investment vehicles that track the performance of currency pairs, consisting of domestic and foreign currencies. Currency ETFs serve multiple purposes. They can be used to speculate on the prices of currencies based on political and economic developments for a country. They are also used to diversify a portfolio or as a hedge against volatility in forex markets by importers and exporters. Some of them are also used to hedge against the threat of inflation. There's even an ETF option for Bitcoin. Inverse ETFs. Inverse ETFs attempt to earn gains from stock declines by shorting stocks. Shorting is selling a stock, expecting a decline in value, and repurchasing it at a lower price. An inverse ETF uses derivatives to short a stock. Essentially, they are bets that the market will decline. When the market declines, an inverse ETF increases by a proportionate amount. Investors should be aware that many inverse ETFs are exchange-traded notes, ETNs, and not true ETFs. An ETN is a bond but trades like a stock and is backed by an issuer such as a bank. Be sure to check with your broker to determine if an ETN is a good fit for your portfolio. Leveraged ETFs. These products use derivatives, such as options or futures contracts, to leverage their returns. There are also leveraged inverse ETFs, which seek an inverse multiplied return. how to buy ETFs. With a multiplicity of platforms available to traders, investing in ETFs has become fairly easy. Follow the steps outlined below to begin investing in ETFs. Guys, we are at the end of the video. If you have enjoyed this, please make sure to hit that like button and share it with your friends and family who might also find it helpful. Your support means a lot to us and helps us continue creating content like this. If you haven't already, don't forget to subscribe to our channel and click the notification bell so you never miss out on our latest videos covering a wide range of topics related to investing, the stock market, the crypto market, personal finance, and more. If you have any questions or suggestions for future video topics, please leave a comment down below. We love hearing from you and always appreciate your feedback. Once again, thank you so much for watching, and we'll see you in the next video.